Welcome to the deep dive. Today we're looking at something, well, a bit puzzling.
Oh, what's that?
Uber Technologies. UBER. They just posted fantastic Q2 2025 results. I mean, really strong numbers.
Okay, sounds good so far.
But here's the thing. The stock barely moved, practically flat for the week after the announcement.
Huh. That is interesting. They tick all the boxes, beat expectations, and nothing.
Exactly. So today, we're going to unpack that. We'll dig into Uber's latest financials, what's driving their growth, and crucially, their whole strategy around autonomous vehicles, the robotaxi question.
Right, because that AV angle seems to hang over them, doesn't it? Despite the current performance.
It really does. So our mission here is to try and cut through some of that uncertainty, give you a clearer picture of where Uber stands.
And we've got plenty to work with. We're drawing on Uber's own Q2 earnings release, their prepared remarks, the earnings call transcript.
Plus some really insightful analyses from places like Reinberg Invest Insights, Accrued Interest, Curiously Wired, Jimmy Investor, even some chatter from the Our Value investing community.
So a good mix of official comms and external perspectives.
Yep. We want to figure out what's really powering their success, how strong that competitive moat actually is, and whether their robotaxi play is, a potential masterstroke rather than the disaster some seem to fear.
Sounds like a plan. We want you to walk away from this with real clarity on Uber's strengths, its potential, and maybe even a few aha moments about how these giant global platforms actually work.
Let's dive in then. Okay, so let's start with those Q2 numbers themselves, because honestly, they look great. Management certainly thinks so.
They weren't shy about it. Dora Khosrowshahi, the CEO, called it another exceptional quarter. He highlighted highly profitable growth driven by record platform audience and frequency.
And the CFO, Prashanth Mahendra-Rajah, pointed to that new $20 billion share buyback.
Right, saying it underscores their confidence after, quote, another quarter of strong top and bottom line performance. Big statement, backing it up with cash.
It really is. And the headline numbers, they didn't just meet expectations, they pretty consistently beat them across the board.
Yeah, the overall picture was one of real stability and strength. Top-line growth was solid. Margins kept expanding. Cash flows were excellent. Just strong fundamentals.
Let's break some of those down. Trips, up 18% year over year. That's 3.3 billion trips in the quarter.
Billion with a B. That scale is just immense. And that activity drove gross bookings to $46.8 billion.
Which was up 17% year over year, or 18% if you adjust for currency changes.
And what's interesting there is that it held steady from Q1's growth rate. Despite all the talk about macro headwinds, potential slowdowns, their core booking volume remained remarkably strong.
No signs of weakness there. Revenue followed suit. $12.7 billion, also up 18% year over year constant currency.
And that beat the consensus estimate by about $230 million. So definitely outperforming expectations on the top line.
But the profitability story might be even more impressive.
This is where you really see the shift in the business. Adjusted EBITDA hit a new record, $2.1 billion.
That's a huge jump, 35% year over year.
Massive. And they attributed it to significant operating leverage, basically. Revenue growing faster than costs and a healthier supply market, meaning less need for driver incentives, perhaps.
Which flows right into margins. Adjusted EBITDA margin reached 16.8%.
Up 180 basis points, or 1.8 percentage points year over year. And this isn't a blip.
No, it's a trend. They've been consistently boosting that margin, up over 12 percentage points since 2022, without a single quarter showing a sequential decline.
That consistency is remarkable, just steady, relentless margin improvement.
And it's not just adjusted figures. GAAP operating income, that's the standard accounting profit, was $1.5 billion.
Up an incredible 82% year over year. That shows the underlying profitability is really solidifying.
Net income attributable to Uber itself was $1.4 billion. That works out to an EPS, earnings per share, of 0.63 cents.
Although it's worth a small footnote on EPS, sometimes Uber's big equity investments, like their stakes in other companies, can swing that number around. In Q2, those investments actually created a small $17 million drag on net income.
So the core operations performed even slightly better than that $1.4 billion suggests.
Exactly. And then there's the cash flow. Free cash flow, or FCF.
Always a key metric. What did that look like?
Very, very strong. $2.5 billion in FCF for the quarter alone, up 44% year over year.
Wow. That's a 20% FCF margin on revenue.
Right. And looking back over the last 12 months, the TTM FCF reached a record $8.5 billion.
$8.5 billion. That's up 80% year over year,
80%. And their EBITDA conversion was 114%.
meaning they generated more free cash than their adjusted operating profit.
Precisely. It shows, as one analyst put it, that Uber's becoming a real FCF machine, just churning out cash, which gives them huge flexibility.
Okay, so billion-dollar profits, record cash flows, beating estimates, everything looks fantastic.
On paper, yes, firing on all cylinders.
So back to the paradox. Why the mild market reaction? Why were the shares practically flat for the week?
That's the multi-billion-dollar question, isn't it? It really highlights that despite these stellar current results, there are persistent investor concerns, especially around autonomous driving, that are just weighing on the stock.
It's like the market sees a potential iceberg ahead, even though the ship seems to be sailing smoothly and quickly right now.
That's a good way to put it. There's a disconnect between the present reality and future fears.
Okay, so let's dig into what's actually driving this current strength. Maybe push back a bit on those fears by understanding the fundamentals. Where does this growth come from?
Well, a huge part of it is just continued expansion of their user base and getting those users more engaged. Let's start with the users' monthly active paying customers, or MAPCs.
They hit a new record high, right? Over 180 million.
Over 180 million, yeah, growing 15% year over year. And what's really striking is that growth rate accelerated slightly compared to recent quarters.
Accelerated. For a company already that big, that's impressive.
It really is. They added a net 10 million MAPCs just from Q1 to Q2, a whopping number. It shows continued momentum in attracting people to the platform.
And there's still room to grow, presumably. 180 million sounds huge. But globally?
Exactly. Estimates suggest that's only about 5% of the adult population in the markets where Uber currently operates.
Only 5%. Wow.
Even in their most developed markets, penetration is apparently less than 20%. And in huge potential growth areas like Europe or India, it's below 5%. So, yeah, a very long runway for just bringing more people onto the platform.
Okay, so more users, but are they using it more, that engagement piece?
That's the other key part. Yes, they are. Usage hit an all-time high. The average user took 6.1 trips per month in Q2.
Up 2% year over year. So existing users are becoming more reliant on the service.
Seems that way. And overall trips grew 18% year over year to that 3.3 billion number we mentioned earlier. That growth rate has been pretty stable over recent quarters.
Which again pushes back against worries about a macro slowdown impacting demand, doesn't it?
It really does. It suggests, as some analysts argue, that Uber services are shifting, maybe from being seen as a luxury to something closer to a necessity for a lot of people.
Post-pandemic lifestyle changes probably play a role there. Less car ownership, hybrid work, city living.
Absolutely. Plus, the sheer convenience and logistical reliance on food delivery. It's becoming embedded in daily routines.
And then there's the power of the platform itself, getting users to use more than one service. The cross-platform strategy.
This is a huge lever for them. The data is pretty clear. Users who use both mobility and delivery are way more valuable.
How much more valuable?
Their retention rates are over 35% higher, and they generate over 3 times the gross bookings and profits compared to someone who only uses rides or only uses Eats.
3 times. That's significant.
Hugely significant. But here's the kicker and the opportunity.
What's that?
Still, only about 1 in 5 users actually uses both services.
Only 20%. So there's massive potential just by getting existing ride users to try Eats, or Eats users to take a ride.
Exactly. There's, as one source put it, a lot of room to run by simply cross-promoting. For example, 30% of mobility users have never tried delivery.
And even fewer have tried grocery delivery, I bet.
You got it. 75% of mobility users haven't used their grocery and retail offering. It's a huge, relatively low-cost growth avenue just sitting there within their existing user base.
How are they tapping into that?
Well, the apps themselves, the main Uber app and the Uber Eats app, are essentially free acquisition channels. They generate almost 30 billion user sessions annually.
Wow.
And over 600 million unique consumer visits in the last year. The little Eats tab within the main Uber Ride app, that alone now generates an astounding $10 billion in annualized delivery gross bookings.
10 billion, just from that in-app link.
Yep. And it accounts for roughly 30% of their first-time delivery customers, so it's a powerful funnel.
And does it work the other way? Getting delivery users to try mobility.
It does. In 5 big markets, they highlighted Australia, Canada, France, Japan, Taiwan on average. 35% of their delivery consumers have never taken an Uber ride. So Big potential to drive traffic back to mobility, too.
And they're using AI to make this smarter, presumably, not just generic prompts.
Definitely. They talked about using larger AI models to encourage that cross-platform activity at the right time, suggesting coffee on your commute or timing grocery delivery perfectly for when you arrive at your vacation rental.
Making it feel seamless, almost magical, as they put it.
Right. It has to be hyper-personalized to work well. And they even reorganized internally, putting both mobility and delivery leaders under a single chief operating officer, Andrew McDonald, explicitly to supercharge our platform strategy.
So a real concerted effort to break down silos and push that integration.
Exactly. More aggressive cross-platform efforts are likely coming.
And underpinning a lot of this loyalty and cross-platform use is Uber One, their subscription program. How's that doing?
It's become a real powerhouse, hit 36 million members in Q2.
36 million. That's huge growth.
Massive, up 60% year over year. They added 6 million numbers just in the quarter.
And how much business do these members drive?
They now account for over 40% of the combined delivery and mobility gross bookings, so incredibly valuable customer.
Is the value proposition holding up? Are new members sticking around?
Apparently so. They said retention rates for new member cohorts are similar to the established base, which proves the program's value isn't fading, and they keep adding benefits.
Like what?
New stuff for mobility, like surge savings in the US that helps with affordability during peak times, which was a big user request, and 10% credit back on Lime e-bike and scooter trips, plus free unlocks.
Making the subscription more valuable across different transport modes.
Right. And expanding geographically, too.
Right.
Launched in Argentina, added mobility benefits in 7 new countries just in Q2. It's becoming a truly global loyalty program.
Okay, so strong user growth, deeper engagement, successful cross-promotion, a powerful subscription program. What else is driving the engine? International.
International expansion is definitely a key lever. Europe and the Middle East, for instance, are seen as a huge opportunity.
Why is that?
Well, gross bookings there are only about half of what they are in the US and Canada, even though the overall market size is estimated to be twice as big.
So much lower penetration, much more room to grow.
Exactly. And Uber is investing heavily there. Trip growth in those regions was nearly 30% year over year in Q2.
How are they achieving that?
By pushing beyond the main Tier 1 cities, increasing penetration in smaller towns, and also entering completely new greenfield markets through partnerships with local taxi companies.
Like where?
They mentioned Denmark, Hungary, Luxembourg, Slovenia just in the first half of 2025, serving another 18 million people through those partnerships.
Smart way to enter regulated markets.
Yeah.
And all this growth needs drivers, right? The supply side.
Absolutely crucial. And their supply base, the number of drivers also grew strongly, up 20% in Q2 to 8.8 million active drivers.
8.8 million drivers.
Why?
That scale is just hard to compete with.
It creates a massive advantage. Faster pickup times, better coverage, more reliability than smaller competitors can hope to match. It's a huge barrier to entry, reinforcing that moat.
And it helps margins too, presumably, if supply grows faster than demand.
Exactly. They see less need for driver bonuses to ensure availability, which directly helps profitability. It's a positive feedback loop. Strong supply leads to better service, which attracts more users, which attracts more drivers, and improves margins.
Okay, that gives us a really good sense of the core growth drivers. Let's zoom in a bit now on the specific business segments, starting with mobility, the traditional rides business. How did that perform?
Mobility showed steady momentum. Gross bookings were $23.8 billion, up 18% year over year in constant currency. Revenue was $7.3 billion, also up 18%.
And trip growth was strong too.
Very consistent, up 19% year over year for the fourth straight quarter, driven by all that user growth and engagement we talked about.
What about pricing? Are they still able to increase prices?
Interestingly, they seem to be moderating pricing power a bit. They actually talked about prioritizing slower pricing growth.
Really? Why would they do that?
To boost user satisfaction and drive underlying long-term growth. They even mentioned passing on some insurance savings to riders. The idea is that slightly lower prices might encourage more frequent use over time.
So a delayed benefit. Sacrificing a bit of immediate revenue per trip for potentially faster overall transaction growth down the road.
Exactly. It's part of what they call their barbell strategy in mobility.
Barbell strategy, explain that.
It means attacking both ends of the market simultaneously. On one end, affordability and expanding the total market.
Like cheaper options.
Right. Scaling things like 2- and 3-wheel vehicles. Their Moto product is over $1.5 billion in annualized bookings now, growing trips 40% year over year. Also, wait and save, where you get a discount for a longer wait time that's in 30 countries. And shared rides, like the Uber shuttle to NYC airports, for around $25.
Making Uber accessible to more people and for more types of trips.
Precisely. Then, in the middle of the barbell, you have the stable UberX core. They're keeping prices there relatively stable through innovation, healthy driver supply, and easing inflation. They mention new ride passes, too.
What are those?
Things like a price lock pass for fixed routes, say your daily commute, or a prepaid pass for buying rides in bulk. Apparently, the price lock users take about 6 more commute trips per month.
So, locking in regular usage. And the other end of the barbell, premium.
Yep. Investing in higher margin offerings. Premium vehicles, Comfort, SUV, Black, are now well over $10 billion in annualized gross bookings.
$10 billion just for the premium rides.
And growing trips over 35% year over year. Even faster growth for reserve trips, where you pre-book. That's up nearly 60%. And Uber for business trips are up nearly 30%. So strong growth at the high end, too.
It's a comprehensive approach, and they're targeting specific groups too, right? Like teens and seniors?
They are. Teen accounts were called a big hit, with 50% sequential growth. And in Q2, they launched senior accounts in all their top mobility markets.
What's different about those?
A simpler app experience, larger text, bigger icons, plus features for family members to help organize rides. It's about making the platform accessible to everyone.
Okay, solid performance and mobility.
Yeah.
What about delivery? You said earlier that's been particularly impressive.
It really has. Delivery keeps gaining momentum, hitting record volumes and profitability, and crucially, it's consistently outgrowing the underlying market across all regions.
Meaning they're taking market share from competitors.
Yes. They now hold either the #1 or #2 position in the vast majority of regions where they operate delivery.
What were the numbers for delivery in Q2?
Gross bookings hit $21.7 billion, up 20% year-over-year constant currency. Revenue was $4.1 billion, up 23%, helped by a higher take rate.
So growing faster than mobility on the top line.
Slightly faster, yes. And trip growth was strong at 17%. But the key metric here, according to analysts, is delivery MAPC growth, the number of active paying delivery users.
And how'd that look?
It accelerated year-over-year for the 9th straight quarter. That's a really critical indicator of long-term success and user stickiness in the delivery space.
9 quarters of accelerating user growth. That's powerful.
Yeah.
What about beyond restaurant food? Grocery and retail.
That's expanding rapidly, too, growing at its fastest rate in 3 years. They added merchants like Family Dollar, Five Below, DICK Sporting Goods in the U.S., and expanded partnerships with big names like Costco and OXXO internationally.
So becoming more of an everyday logistics platform.
That's the goal. They now fulfill over 2 billion orders quarterly across about 30 countries. But again, huge potential remains. Only 18% of delivery users order grocery or retail monthly. Lots of room for growth there.
Are they making acquisitions in delivery too?
They are. They acquired Trendyol Go in Turkey for about $700 million in cash. Turkey is a big market where they see leadership potential.
And partnerships.
A significant strategic partnership with iFood in Brazil. They'll integrate Uber rides into the iFood app and iFood delivery services into the Uber app.
More of that platform synergy connecting the ecosystems.
Exactly.
What about the freight segment?
Freight is their digital logistics marketplace, connecting shippers and carriers, mainly in North America and Europe. Performance there was a bit softer. Gross bookings were $1.26 billion, down slightly, about 1% year-over-year constant currency.
So not the same growth trajectory as mobility or delivery right now.
Not currently, but it's still a significant business and part of their broader platform vision for logistics.
And one more piece we haven't touched on much: advertising. How big is that becoming?
It's becoming surprisingly significant and very quickly. Launched in 2022, it's already operating at a $1.5 billion annual run rate.
$1.5 billion.
Yeah.
Already.
And growing 60% year over year. And crucially, these are described as excellent, high-margin, fast-growing revenues.
So directly boosting overall profitability.
Significantly, they use Uber Journey ads, showing ads during rides or deliveries, allowing brands to reach consumers at relevant moments. They had over 500,000 active advertising merchants by the end of last year.
It all ties together, doesn't it? The different segments feed each other?
That's the core idea. The synergistic platform dynamics, integrating mobility, delivery, and freight, creates compounding advantages. Remember that stat, 60% of first-time delivery users in Q4 2023 were new to Uber entirely.
So delivery is bringing brand new customers onto the platform.
Exactly. And users who engage with both services are far more active, averaging 10.5 trips per month versus 5.0 for single service users. It's a powerful, self-reinforcing ecosystem.
Okay, let's pivot now to the elephant in the room, the topic that seems to spook investors the most: autonomous vehicles, robotaxis.
Right, the perceived existential threat. But the narrative here is shifting, and many now see Uber's approach not as defensive, but as a potential masterstroke.
How so? Their decision to sell off their own AV development unit years ago seemed like admitting defeat at the time.
It did to some, but retrospectively, it looks incredibly shrewd. Instead of pouring billions into the incredibly expensive and uncertain race to build the best AV tech, they positioned Uber as the essential platform for any successful AV operator.
Ah, so be the marketplace, not the manufacturer.
Precisely. Think about what Uber offers an AV company. Instant access to 180 million active users globally, operations in over 70 countries, a trusted brand name for transportation, deep integration into how people already move around cities.
Things that a company focused purely on the tech would take years, maybe decades, and billions of dollars to build themselves.
Exactly. Uber offers scale, brand, and ready-made demand, the very things AV companies lack most. It's a capital-light way for Uber to potentially dominate the robotaxi market, regardless of whose specific technology wins out.
So they benefit no matter who builds the best robot car.
That's the strategy. They avoid the massive R&D and manufacturing costs, but capture the demand side of the equation.
Which helps debunk those disruption fears. The idea that, say, Tesla might just launch its own network and cut Uber out.
It certainly challenges that idea. Building a fleet is one thing. Building a trusted, scaled, multi-market consumer platform is entirely different. Uber spent over a decade, billions of dollars, solved countless local regulatory puzzles, and earned user trust over 131 billion miles of trips.
That's not something you replicate overnight, even if you're Tesla.
Highly unlikely. The core advantage Uber has is the liquidity of that marketplace. Enough riders and drivers, or AVs, in one place to ensure short wait times and high utilization. Why would an AV operator spend a fortune trying to build that demand from scratch when they can just plug into Uber's existing network?
And why would a rider switch? If the Uber app they already use offers both human drivers and AVs, why download a separate, likely less available, untested Tesla robotaxi app?
Exactly. Consumer habits are sticky. People are conditioned to open the Uber app for rides. Overcoming that inertia is a huge challenge for any new entrant, AV or otherwise.
There's also the issue of variable demand, right? Rush hour versus midday.
A critical point. Ride-sharing demand fluctuates wildly. A standalone AV fleet faces a tough choice. Build enough supply for peak demand and have expensive assets sit idle most of the time, or build for average demand and be totally unreliable during peak hours.
Neither sounds ideal.
Not at all. Uber's hybrid model, combining human drivers and AVs on one dynamic platform, is much better positioned. They can use human drivers, perhaps incentivized with bonuses, to handle peak demand, costing them nothing when demand is low. It allows for much higher overall asset utilization.
Plus, Uber has all that operational experience, dealing with lost items, fare disputes, breakdowns.
15 years of it, handling all the messy, real-world stuff. AV partners can plug into that existing infrastructure instantly. Customer support, payment systems, insurance handling, even managing the logistics of charging, cleaning, and servicing the AVs themselves. It's a massive operational advantage.
So the argument is, Uber isn't threatened by AVs. It's enabling them.
That's the core thesis. It's becoming the indispensable gateway for AVs to reach mass market scale. And the Q2 progress really backs this up.
What did they announce on the AV partnership front?
They now have 20 AV partners across mobility, delivery, and freight. Management said they're full speed ahead and expect to operationalize around 5 new mobility deployments in the second half of this year alone.
20 partners. Who are some of the key ones? Waymo.
Waymo is a big one. Uber now offers Waymo AVs exclusively on its platform in Atlanta. Results are apparently well above expectations. With high vehicle utilization, they plan to add hundreds more vehicles there.
Exclusively on Uber in Atlanta. That's significant.
Very. And they doubled the Waymo service area in Austin. With this, the average Waymo AV on Uber is reportedly busier than 99% of our human drivers.
Wow. Shows the demand is there when the platform connects it. Any others?
They expanded with WeRide in Abu Dhabi, launching in Riyadh soon. A massive deal with Baidu's Apollo Go in China, planning to deploy thousands of Apollo Go AVs on Uber across Asia and the Middle East.
A Chinese AV giant partnering with Uber globally. That's telling.
Extremely telling. Then there's a unique program with Lucid providing the cars, Nuro the AV tech, and Uber the platform. This will actually be Uber's own small fleet, but the cost is apparently minimal, less than 0.1% of the market cap.
So they're experimenting with different models.
Exactly. They also signed an exclusive deal with Volkswagen to deploy VW's AVs, starting tests in LA, and a broader partnership with Way for Trials in London.
It sounds like they're increasingly partnering directly with the car manufacturers, the OEMs.
They are. Management sees building affordable AV hardware at scale as the really hard part now. Uber brings the demand and the balance sheet to help make the economics work for those OEM partners.
So how does Uber make money from these partnerships? What are the business models?
They anticipate three main models. One is a merchant model. Uber pays the AV partner a fixed rate, takes the revenue risk itself. Second, an agency model, basically, revenue sharing, similar to human drivers.
Okay.
And third, an asset ownership plus licensing model. Maybe Uber or financing partner owns the vehicle, and they license the AV software per mile or monthly. This flexibility lets them work with different partners in different ways.
And beyond just connecting rides, they're leveraging their data too.
Yes, this is another interesting angle. They're positioning themselves as central to the real-world AI revolution. Why? Because they have arguably the world's richest data set on urban mobility. Billions of trips. Every condition imaginable.
Invaluable for training AI, not just for driving, but potentially other applications too.
Exactly. They've launched Uber AI Solutions, a growing business using their global network of earners for tasks like data labeling, map labeling, translation, algorithm tuning, essentially externalizing their AI infrastructure capabilities.
So leveraging their platform assets in entirely new ways. Fascinating. Really reframes the whole AV narrative from threat to opportunity.
Absolutely. Now let's connect all this back to the financials and the investment picture. What's the outlook?
Well, the Q3 2025 guidance they gave suggests the strong momentum is continuing. It wasn't just a one-off great quarter.
What are they forecasting for Q3?
Gross bookings between $48.25 billion and $49.75 billion. That represents 17% to 21% year-over-year growth in constant currency, maybe slightly lower, 16% to 20% if you exclude that Trendyol Go acquisition.
Still very healthy growth in the high teens. And adjusted EBITDA.
Expected between $2.19 billion and $2.29 billion. That's 30% to 36% year-over-year growth.
So continued strong top-line growth and even faster profit growth, implying further margin expansion.
Yeah, exactly. The overall take was that it's a solid outlook, pretty much in line with what analysts were expecting. Continued high teens, bookings growth, expanding margins, and rapidly growing cash flows.
That profitability trajectory is really key, isn't it? We talked about the margin expansion already up over 12 percentage points since 2022. Where do they see it going long term?
They projected a long-term adjusted EBITDA margin target of 25%.
25%, compared to around, what, 17% now?
Close to 17% in Q2, yeah. So significant further expansion planned over time.
And the free cash flow machine just keeps running.
Looks like it. That $8.5 billion in TTM FCF, the 114% EBITDA conversion, it demonstrates real earnings power. Analysts are projecting FCF to keep growing over 20% annually.
And they're putting that capital to good use. Reinvestment returns look good.
Very good, actually. Their trailing 12 months return on equity, ROE, was an impressive 46%. And a return on invested capital, ROIC, was 19% and trending up strongly. Shows efficient use of capital.
What about the balance sheet itself? Lots of cash. Debt.
Pretty solid. They ended Q2 with $7.4 billion in unrestricted cash and short-term investments. Plus, they still hold about $8.7 billion in equity stakes in other public companies.
Like their DD stake, Grab stake, etc.
Exactly. And they plan to opportunistically monetize those stakes over time, using the cash for things like AV investments or strengthening the balance sheet. They actually sold off $1.2 billion worth in Q2.
So that $8.7 billion is a potential source of future cash. What about debt?
They have about $12.3 billion in debt, so technically a net debt position, but given the massive cash flow generation, it's generally seen as quite manageable.
And that strong cash flow allows them to return cash to shareholders, that buyback program.
Yes. The really big news was the new additional buyback authorization of $20 billion.
On top of what they already had. Right. It brings the total current authorization to $23 billion.
$23 billion. That's huge relative to their market cap.
It is. It would allow them to buy back roughly 12% of their outstanding shares at current prices. Management called it a massive vote of confidence and a good use of cash.
Are they actively buying back stock?
Very actively. They said returning cash to shareholders is their #1 concern right now. They're allocating around 50% of their free cash flow to buybacks, explicitly aiming to reduce our share count.
How much did they buy back in Q2?
$1.4 billion worth. That brings the total since the program started in early 2024 to $4.4 billion. So they're definitely executing on it.
Okay, strong outlook, improving margins, massive cash flow, big buybacks. So why the relatively low valuation? Let's revisit that.
It's still the puzzling part. As of mid-August, the shares traded at around 31 times this year's expected earnings. The PEG ratio, which compares PE to growth, was just over 1x, and it was about 23 times trailing 12 months free cash flow.
Which sounds pretty reasonable for a company growing like this.
Many analysts think so, despite the stock rallying significantly earlier in the year, up 37% year-to-date by May and 41% from December to June. Several analyses still called it a deep value pick, or a bargain.
Where do analysts see the price going?
Target prices mentioned in our sources range from around $107 to $127 per share, which would imply potential annual returns of 14–17% from here, based on hitting certain EBITDA or FCF multiples in the future.
So what caused the valuation to be relatively low in the first place?
Sentiment really soured in late 2024, largely due to those robotaxi fears. The PE multiple compressed significantly. The strong earnings reports since then have helped debunk those fears, leading to some multiple expansion, that plus 37% run-up.
But maybe not fully reflecting the underlying strength yet.
That seems to be the argument. Super investor Bill Ackman put it starkly. He called Uber one of the best managed and highest quality businesses in the world, yet one that could still be purchased at a massive discount to its intrinsic value. He called that combination extremely rare.
High praise, suggesting the market might still be catching up to the reality of Uber's transformation.
Definitely. And sometimes understanding that transformation requires a quick look back. How do we even get here? The origin story is pretty well known now.
Right. Started in Paris, 2008. Travis Kalanick and Garrett Camp couldn't get a cab on a cold night. Classic startup story.
Exactly. That frustration led to the idea, initially, for a timeshare limo service via app. Then UberCab.com launched in San Francisco in 2010, targeting tech folks.
But they ran into trouble with the name cab pretty quickly, didn't they?
They did. San Francisco regulators sent a cease and desist saying they weren't a licensed cab company, so they smartly rebranded as just Uber, signifying something bigger, a technology platform, not just a taxi service. That name change was quite pivotal.
And then the expansion began. Uber Eats launched in 2015.
Yep, diversifying beyond just rides, massively increasing their total addressable market, the TAM. Then the IPO in 2019, valued at $75.5 billion initially.
And they navigated the pandemic pretty well by leaning into Eats when mobility shut down.
They really did. Uber Eats exploded in 2021. By 2023, they marked 15 years, hitting over 130 million monthly active users, cementing that global leadership position.
And the core model is that asset-light platform, connecting riders with drivers, eaters with restaurants and couriers, shippers with carriers.
Right. The taxi company that owns no taxis, it's all powered by their technology platform across those three verticals: mobility, delivery, and freight. Operating as a complex 2 or even 3-sided marketplace in, 70 countries now?
Using tech like Google Maps API, dynamic pricing, all that sophisticated stuff to make it work at scale.
And that scale and technology have built some serious competitive advantages, that moat we keep talking about.
What are the key pillars of that moat?
First and foremost, the massive network scale. Tens of millions of participants, drivers, consumers, merchants, carriers across over 10,000 cities globally. It creates that powerful network effect.
More users attract more drivers, merchants, which improves the service, which attracts more users. A virtuous cycle. Very hard for competitors to break into.
That's exactly. Second is their proprietary technology leadership. The algorithms for demand prediction, dispatching, pricing, payments, they're constantly learning and improving, giving them an efficiency edge. More data, more capabilities.
Third,
operational excellence. Having local teams with deep market knowledge allows them to launch quickly and navigate tricky local regulations in thousands of different cities. That global approach, global platform, local execution.
And fourth, the integrated ecosystem, the super app idea.
Right. Things like Uber One, bundling services, making it seamless to use rides, eats, groceries. It deepens engagement and makes the platform stickier. They had 19 million members in loyalty programs by late 2023.
And finally, that new advertising business leverages the whole network for high-margin revenue.
It all reinforces itself. It's a powerful combination of advantages.
But it's not without challenges or risks, right?
Yeah.
It's a tough business.
Absolutely not. Competition is intense. You've got Lyft, DoorDash, Didi in China, Grab in Southeast Asia, Bolt in Europe, plus countless local players. It's a constant battle.
And the regulatory pressures never really go away, do they? Especially around driver classification.
That's a persistent overhang. The debate over whether drivers are employees or independent contractors continues in many places and could significantly impact their costs if regulations change unfavorably.
What about operational costs generally? Insurance, tech development?
Still significant. They constantly invest in tech, compliance, sometimes driver incentives. The expectation is these costs become a smaller percentage of revenue as they scale, but they're always there. Insurance, payment processing, hosting, marketing.
Macroeconomic issues could still bite too, if inflation stays high.
Potentially. If people feel squeezed, they might cut back on luxury services. Although, as we discussed, Uber seems to be shifting towards being seen as more essential. And their global footprint helps diversify risk. A slowdown in one region might be offset by growth elsewhere.
And the AV risk, while maybe reframed, hasn't totally vanished.
No. If the deployment of reliable, scalable AVs gets significantly delayed or fails to materialize as expected, it could impact their long-term strategy, which is banking on integrating AVs eventually. But the current strategy aims to make them a beneficiary, not a victim of that transition.
So the short-term challenge is really continuing that shift from convenience to utility in consumers' minds.
That seems key to sustaining demand and pricing power through any economic cycle.
All right, let's try and wrap this all up. We've covered a lot of ground here on Uber.
We certainly have. From that stellar Q2 performance, strong growth, expanding margins, huge cash flow.
To the underlying drivers. More users, deeper engagement, the power of that cross-platform strategy, and the success of Uber One.
And then we really dug into the autonomous vehicle angle, arguing how Uber's partnership-first platform approach might actually be a brilliant strategic move, positioning them to benefit from AVs rather than be disrupted by them.
Right. Add in the disciplined capital allocation, the massive share buybacks. It paints a picture of a company that's financially strong, strategically savvy, and maybe still undervalued by the market, despite its recent run-up.
A complex picture, but one with significant long-term potential, it seems.
So for you listening, what's the takeaway here? Understanding Uber's story is, I think, a great case study.
Definitely. It shows how a dominant platform navigates change, diversifies, and crucially finds ways to embrace potentially disruptive technologies instead of just fighting them.
It highlights how focusing relentlessly on customer value through convenience, affordability, premium options, integrating services combined with building an unmatched operational network can create a really powerful, durable, competitive advantage.
A modern moat built on network effects and technology.
Exactly. Which leads us to a final provocative thought for you to chew on.
Okay, let's hear it.
Given Uber's success with this capital-light platform model, leveraging external assets like driver's cars, restaurant kitchens, maybe soon AV fleets, and now even starting to externalize its AI capabilities, how might this whole super platform approach, this blueprint, be applied to other large, fragmented industries? Industries that also rely on balancing supply and demand, maybe using underutilized assets.
Interesting. Are we talking beyond just moving people and things?
Could be. Could Uber's model eventually reshape sectors like, say, temporary staffing, equipment rental, maybe even certain types of freelance work or professional services? Does it change how we think about asset ownership, network management, and the future of coordinating work itself, especially with AI playing a bigger role?
That's a big question. Could the Uberization model, refined and amplified by AI, spread much further than we currently imagine?
Something to think about. The potential implications are definitely vast.
Food for thought indeed.
Well, that's all the time we have for this deep dive. We hope we've brought some clarity to the complex world of Uber. Thanks for joining us.
Thanks for listening. We'll catch you next time on The Deep Dive.